I've been trading since 2017 and I did a lot of things wrong for years. Overthinking, blowing accounts, hesitations, strategy hopping. Then last year it finally clicked in and everything came together. If I had to start from the beginning, this is exactly how I would do it to become profitable and fund a trader without wasting thousands of hours on YouTube and garbage courses. This video is a full trading roadmap, everything from A to Z that you may need to become a profitable funded trader in 2026. Nowadays, I have no problem passing funded accounts and getting payouts, but it wasn't always like this. A year ago, I was stuck in the same cycle that you might be in right now. One good week, and then I would give it all back. Not because I didn't know how to trade, but because I didn't trust myself to stop. Every loss turned into overtrading, every setup turned into second guessing, and every red day eventually turned into a revenge trading day. So I did what everybody does. I watched more YouTube videos, bought more courses, studied ICT concepts, price action theory, smart money, all of it. You name it, I watched it, heard about it, or studied it. I thought I was missing one more strategy, one more edge, or one more secret that I wasn't aware of. I wasn't. I was missing confidence, not information. Everything changed and I stopped chasing strategies and I start building a repeatable process. I turned trading from guessing and hoping into something mechanical, repeatable, and consistent. A system I could execute every day, pass funded challenges, and rinse and repeat. And I'm going to take you step by step from setting up your trading view to execute your first trade, passing your funded challenges, managing risks, times to trade, proper journaling, psychology pitfalls, and avoid overall rookie mistakes. All the way until payout, because once you get there, then making money becomes obvious. If you follow what I'm about to teach you, you will walk away with everything you need to do from not knowing how to set up TradingView all the way until passing your account and getting a payout without second guessing and just a clear path. I'm going to show you every single step that needs to be done so you can go from I don't even know where to start to I just got my first payout as soon and as fast as possible. So let's get started. All right, so the first thing is how to set up your trading view. So you can copy my settings or you can set it up however you like to set it up, but I'm gonna go over all the things that you need. And for the sake of simplicity, we are going to focus on futures market, how to trade prop firm futures. If I would have gone back into my journey and I could have advised myself on what to trade and how to trade, I would just tell myself stay away from crypto and stay away from options trading, stay away from forex trading, stay away from all the unregulated CFD brokers, and just go straight into futures trading, specifically prop futures trading. Because prop futures trading is pretty much the simplest one that you can start with. As far as the cost of it goes, it's the least amount of cost because if you start with Forex, first of all, you either have to use your own fund or you have to use a very complicated multiple phase challenges to pass to then to get it to the funded stage and then to get the payout. So if you've never traded before, just you can Google or chat GTP how to trade futures and get some understanding of what futures market is. I don't want to bore people with what the futures market is, but just take my word for it. It's the simplest way for you to get started, especially if you trade prop firms trading. And prop firm trading is the one that I recommend anybody start doing, is because let's assume you put $1,000 into a cash account. You're gonna burn through that $1,000 cash account extremely quickly without even realizing it. You may burn it within a week, within a couple of days, or you might just be stuck with it within a couple of months. Doesn't matter. But with $1,000, $2,000 that you saved up, you can buy between 10 to 15 accounts. And the accounts that I recommend getting is a 50K account on any prop firm accounts. And I'll go over all the details with you. But for now, we're just going to stick to how to set up your trading view. And I'm going to add timestamps for all these different sectors. So if you need to skip to a different area, you're more than welcome to do so. So when you set up your account on TradingView, this is the first thing that you're going to see. For me, I already set some of these up, but you're going to see some indices in here. You're going to see some Forex and some other stuff. Delete everything. Just go into your, let's say, for example, you find NASDAQ. You just go to your NASDAQ. Let's say you want to add an asset. You just go here, click on add a symbol. Oops, I don't think you can see it. So let me just move this over here. There we go. So you can just here click on add a symbol. You can just click on add a symbol. You see how it says all of these? You just go to the futures market. Once you go to the futures market, you can add NQ. And it's usually one of the top two. You can switch them based on every quarter, but you don't need to. If you get one of the top two or one of the top three, it will just automatically switch the contract that you need to trade with. And you just click it as a favorite. You just add it to your favorite and mark it red or whatever you need to do. Then if you want a Forex, you can just create a whole different bracket for the Forex trading. And for regular watch list, you can do something like that. So the assets that I'm looking at all the time is ES, which is S&P 500s, NASDAQ. I look at gold. I look at silver. I look at MNQ, which is micro NQ. And as a beginner or somebody who hasn't got a funded account or somebody who never passed the challenge account, you want to start with micro contract. So for example, on NQ, every tick, when the price, for example, goes from here to here, as you can see, it's about 4,850 ticks. So if you don't know about futures market, in futures market, each tick has a dollar value attached to it. For example, NQ on each tick is about $20. Sorry, on each point, it's about $20. On each tick, it's about $5. And then if you go to the micro contract version of these indices or even the metals part, they get cut by 10th. For example, each tick on an MNQ market is worth about 50 cents and each point is worth about $2. And later on, I'm going to explain a little bit more when you're placing order, when you're setting your stop losses and risk management. Those numbers will come handy when you're looking at it. Let's say you added all these assets. You added S&P, gold, silver, and these are all the futures market. If you go under futures, you'll see them under futures. And then MGC is the micro gold, and MES is the micro ES. And I added Bitcoin and Ethereum just to look at it. And I have Dow Jones here. I don't trade Dow Jones. I have a dollar value in here, and I have oil, crude oil, and I have the regular silver. So the ones that you want to be stuck on and pay attention to are NQ, gold, and possibly silver. But as a beginner that never passed any challenge or never got any payout, completely get rid of silver. Just stick to NQ and gold. And you want to trade their micro version, which is MNQ and MGC. So those are the ones that you want to be stuck at, and don't worry about anything else. And if you want to copy my settings, first of all, at the bottom you want to set these as minus. So where it says use the settlement as close on daily interval, you can set that, and here adjust for contract changes. See? So if I click on this, you kind of see that the gaps get closed easier. So yeah, just adjust it for contract changes and set yours to daily intervals. And these are your favorite tools up here. And the way you see the favorite tools, let me move my screen so you can see them better. There we go. So all your tools are here. So you can kind of go through your tools and add a certain favorites. The ones that you're gonna need is a long position, short position, which is, you can find it in here. There we go. So long, let me just show you all my favorites so you can just copy me. Trend line and horizontal line, put it to your favorite. In here, I only have the GAN box that I don't use much, and I have a certain setting for it that you don't need to. That's when I want to measure like halfway through a certain point. And in here, I don't have any favorite on this section. In here, I have long position, short position. I have a fixed range volume profile as a favorite. I have price range as a favorite. You don't really need most of these. Arrow, you might need this one. Rectangle, I use this one. And path, I use that one as well. This one, text, I use this one, so I put it as a favorite. And that's pretty much it. And in here, this is where you choose what cursor mode do you want to use. So I usually use this one, which it's easier for me to go over the lines and demonstrate what I'm about to show. That's pretty much it. And then as far as the time frame goes, these are my favorite time frames. The 15 and 30 second, you don't need to use it, and you don't want to use it unless you really need to. And you have to pay for extra premium on TradingView to use them. So I wouldn't even worry about this. They don't come as handy and as often. The ones that you're going to need that comes with a plus, I think, package, which is pretty easy to get, which is 1 minute, 5 minute, and 15 minute. Also an hour, the 4 hours, and daily, weekly, and monthly. So those are the ones that I have them as a favorite. So if you want to copy me, you can go ahead and copy that. And as far as settings, so let's go to my settings. If you right click, go to your settings. So these are my settings. So if you want to copy my settings, go for it. Currency unit, always visible on the mouse cover. I unmark these. Plus button, I mark them. Countdown bar close, I have that one marked. And these one, pretty self-explanatory. You can kind of copy them if you want. On the symbol, so the way I like to do mine is on the body. If it's bullish, I put them on blue. If it's bearish, I put them as red. For borders and wicks, I put them as black because I can see them better on the chart. Like no matter how much I zoom, I can see them more clearly. And if they're close enough, I can see the wicks and the body closes clearly. And you can also, for data modification, you can have both of these activated. And precision, put it at default. And time zone is really important. Always put your time zone on the New York time. That's when you can follow different things as far as news goes. Status line, you can go through logo and title. Those are the ones I have. Titles, values, and background. Those are that. Scale and lines, you can kind of copy what I have in here. Same goes in here. Canvas, and that's my canvas settings. If you want to just copy what I have in here. Here we go. Trading. So this one is important. You kind of want to copy what I do. So I have my buy and sell button activated. This one, the one-click trading activated. Execution sound is activated. Show only rejection. I don't have that one. I have all of these activated. Execution mark. I only activate this one if I want to see a certain trade after the trade is done. Position on brackets, I usually put them on the tick value instead of money. But if you're a beginner, super beginner, leave them at the money. But for psychological reasons, I put them as a tick value because I usually have an amount in my mind that I'm willing to risk and I'm willing to take profit on. And I know what that value is based on tick value. Because when you see a dollar amount going up and down on your screen, you may make a lot of psychological mistakes. Versus if you see a tick value, it just turned it into a game more than you wanting to make money. And that's that. Alert. These are my alerts. Events, I don't have any specific events, continue contract switch. I have that one alerted on. And you can put all the latest news. You can put news notification. You can put contract switch breaks. You can kind of see where the contract is going to get switched. You don't need to, but you can. Ideas, you can put different ideas, but you don't need to. I have that one off. Yeah. So you're gonna have all of these. That's my setting. So we covered the tools that we're going to use. We covered the settings on the TradingView itself, and now we're gonna go through the indicators. So I have some indicators that I use sometimes, and sometimes I don't use some of these indicators. It's just really up to you. Most of the indicators I use is just pretty much they're visual indicators to kind of help me what's going on, and they are free. You don't need to pay for any of these. For example, you can add something called a watermark. You can add like something as a reminder if you wanna have a certain stop loss or certain take profit, or there's something that you want to be reminded about. You can add that called AGFX watermark. I don't use it as much. And this one is a daily range dividers. So this is how I divide all my all the days. As you can see, Tuesday, Wednesday, Thursday. It says here. If it's off, it doesn't show any of the days. If I have this on, it'll show what days I have. And then you can go through its setting. There's a setting button. You can set it up to however you want, different color, or just different highlight for different days. Session, I have my sessions on for the New York market. So whenever I'm trading, I always know where the New York market opened, closed, or what's going on the live market. I have another one that's called alert on candle close. So this one is the one that I use the most. So this one you can just get it in. And if you want to add any of these indicators, you can just go to the indicators. You can go to search and then search for that indicator in here, and it'll just pop up, and you add it to your favorite, add it to your TradingView. So the next one is something called ICT, HTF candle, higher time frame candles by Fatty. Of course, it's free. That means you can go to your setting and you can set whatever time frame that you want to show for you when you're going towards the lower time frames. So mine is always set on 15-minute and hourly. So meaning if I go to 1 minute, for example, on the right side, I can see what's going on in 15 minutes and I can see what's going on the hourly. And the alert on candle close, you can just click on the more section and click alert on candle close. So if I want to be notified when the hourly candle closes, or if I want to be notified if the hourly candle closes, I can just go here, choose that candle, and then set the alert if I want it to be once or it triggers every time that candle closes. Volume profile is also free. You don't need it. I sometimes use volume profile to see if I can determine whether if you are having a fake volume or a real volume. And by fake and real volume, I'll show you what I mean with that. Let me just get rid of all of these. So in here at the bottom, if you can kind of see in these sections, we have a lot of upwards volume. So if the New York market's open and we have a lot of volumes on the hourly or 15 minutes, I know that we usually have either one or at least two more hours of high volume, depending on whether if we are going up or we are going down on the higher time frame. So that's my volume button, and you don't need these other two. I don't even use them as much. Those are the indicators that you're going to need. They are free. And let's go ahead and break down the simple market structure. So the market structure, we either have like three of them. The market either moves up like that. The market either consolidate like this. We call them choppy market. Or the market continuously goes down. That's like the most simplest form. Oops. That's like the most simplest form. I can go over this with you. So yeah. So the market does these three things. So we want to trade whenever market is going up. You want to trade when the market is going down, and we want to avoid when the market is choppy. Simple as that. And the way I trade is called, and I didn't come up with it, it's called different names. You can name it different things. Break of structure, as ICT people call it. You can call it break and retest. You can call it ICC, which is indication, correction, continuation. And the entry model is called CCT, candle continuation theory. And the strategy is very simple. So when the price goes up and we're continuously going up, we just mark a certain area. Once we mark that certain area, when the price closes below it and close above that area again, we just get in and we market two areas. So we either mark at the top of the previous high, or we either mark up some sort of high in this area or some sort of psychological number on that area. And same goes when we are going down. So if we're going down, if you break a certain area, the price always likes to go back to the same area that we broke through. And once we start going back down again, I just go short, put my stop loss on top of that swing, and put my take profit at the most recent swing. Or, like I said, at a certain psychological number or one of the previous swings. That's pretty much it on that one. So, and there's another thing that I need to mention. So let me just do it on the 5 minutes so I can draw better. There we go. So market is not clear cut. I wish market was like that. So we have two type of liquidity in the market. We have a external liquidity and we have internal liquidity. So external is this area. So this is external liquidity. This is external liquidity, this area. And this is what we call a internal liquidity because it's internal. It's between the 2 points. It's between the starting of the trend and it's halfway through at the most recent swing. So it's called internal and these two are called external. So it's very important because the price doesn't just do this. The price doesn't just cleanly go up or cleanly go down. So the price goes up sometimes, goes down, goes up, and then comes back, take out a little bit more orders, and then start going back up again. And same thing here, it may come back and it'll go down. And I'll show you live examples of all these different patterns. So if you're aware of what is internal and what is external, you can kind of tell that, hey, if the overall trend is up, we can either get into two different positions. So we can either wait for something called a POI, a point of interest, or we can wait for a liquidity sweep and then get into the trade. And then you can like memorize, you can save different letter for different trend line. So I have mine all saved up. So I can call this one a POI. I can call this one a liquidity sweep. And these would be my target area. So I have two target area and I have two areas that I want to get in. So the price can either come here and start going back up again. If it start going back up again, I just get in and I target these two areas. Or I can wait for the price to come and grab these internal liquidities. Once it reverses, start going up again, then I can target a better risk to reward ratio and get more out of it overall. And it's the same way when it's the other way around. So if you are going bearish, the price may come do this and then this. And we have two areas to target. So we have this area for a POI and we have this area for a liquidity sweep or turtle soup. Some people call it turtle soup. Nope, not that area. There it is. And there it is. So yeah, Same thing when it's when the price is bearish, we just wait for the price to break through a certain level on the hourly or 15-minute or 4 hours or daily, and then we just get in. So we're gonna wait for either the price come down to the POI and start going back the other way, or we just wait for it to grab all the liquidity from internal level and start going back. So we either get two. So the price either comes all the way back to the initial target, which is in the middle, or it goes back and sweeps all the liquidity start before going up again. For example, this is like a live examples of it on gold. So as you can see, the overall trend is up. So we're just going up, going up, and then we make a low, and then we start going up again, and that low, it kind of covers this area. So if you can see, we have this one. We can call it a POI. And we also have this one that we can call it a liquidity sweep. And we also have this area, we can call it POI. So you kind of want to see when we are on the uptrend, you kind of want to see where the price comes out and then gives you an opportunity for you to get in. So in this area, the price came and gave you two opportunities. So it came down below it, closed above it again. Once it closes above it again, then you just get in here. You can target this most recent high, put the stop loss below here, and then walk away for a nice, quick 136 tick. Or you can just wait for another liquidity sweep. As you can see, we can see multiple examples of it. We're going up, we sweep multiple internal going up again, and then same thing, sweep internal go up, didn't sweep internal but sweep POI go up, and so on and so forth. It just the prices does the same thing. I just came in, sweep these internal liquidity, and then went straight to the external area, and that's it. So you either see this pattern or you see this pattern going up. And it's the same way if it's the other way around. So, and then my entry models are very simple. So the entry models are, let's say we are going up. So if we're going up, there's always an area they'll show you a like a gap in the market. If it's called usually a fair value gap or an inverse fair value gap. So these gaps, they like to be filled. They either like to be filled or the price likes to revisit them before going up. So you have two options. You can either get into the order right away or set a limit order for the price comes down to that area and get in. But it's a little bit more riskier to set a limit order. So I don't usually do that. I just get in the market right away. So let's see if I have any example of that. Yeah. So here's the example of it. So let's say we inverse this area. So there's a gap here. We completely inverse that. Once we inverse that gap, then we create another gap. As you can see, the price came and visit that gap again. It usually visits halfway through or at least touches it before going up again. So you can do something like that. But since it's not guaranteed for the price to come revisit that area, I just get in right away. So you might ask, how do we go from finding out what is the trend? So the easiest way for you to find your trend is by going on a daily. Once you're on a daily, you can kind of see on the daily price action if we close all the drawing. So on the daily, you can see it's very simple. You just keep going up, keep going up. So if the daily is going up, you can kind of expect that, hey, you're going up. So you can mostly look for longs if the overall trend is high. And then you can also look at the 4 hour. Are we going up? We're going down? Of course, we're going up Pretty simple stuff. So we're just continuously going up. But if you're trading prop firms, it's kind of hard to trade that based on daily and 4 hours. So the ones that we are going to look at is pretty much hourly. And on the hourly, you kind of look for our hourly levels to give us a area of interest, a point of interest, or a liquidity sweep for us to get in it and get out. Let's say we want to get out here. So I don't even need to zoom in for you to see it. Let's say we have 2 candle closes, same color code, 2 candle closes, and I mark my area. As you can see, the price came above it and continued. And the same goes if the market is going the other way. Let's say we have 2 candle closes consecutively. I just draw my line here like this, and I always draw 2 lines. Usually I draw a line, I call it a POI, and like I explained, I draw another line, and I'm gonna call it a liquidity sweep to see which line gets respected. You can also do this, but the price will less likely gonna come visit that area. So yeah, that would be your areas for you to take a look at to take trades on. But you might say, hey, we're just going back. Aren't you afraid? No, I'm not, because the overall trend is just we're just continuously going up, and we have a clear target to go hit from this side. And once we go to the minute, we just zoom in. And as you can see, the price broke through this area, did not close above it. The price went and grabbed more liquidity, the internal liquidity, and start going back up again. Usually I wait for a candle close above that area again, or I wait for some sort of inversing a gap. So we didn't inverse this one, but we close above it, came back below, close above it, then that's the area where I would get in. Or I would have a target for this area to come get filled out. So I would set a limit order in this fair value gap in here. As you can see, the price came and touched it again. Or you can just set the limit orders, and then the price continue to go up, take out this area, and eventually, of course, we want to hit that area. So that's what the price does. The price either goes from a liquidity to a liquidity, or the price likes to come back to an inefficiency, which is a fair value gap on the hourly or the 4 hours or the daily, and then continues to its direction, which is usually some sort of external liquidity somewhere in here. And for you to pass your accounts and get these accounts funded and all that, you don't really need all these moves. All you need is maybe a fraction of what you may think you might need. As you can see, I color code everything. So the reason why I color code everything, if there's a daily gap, if there's a weekly gap, if there's a daily line that we broke through, I usually mark all of these so I have a visual representation of where the price is going and where the price has been. And I'm gonna show you what to avoid. For example, this is what you want to avoid. When the price is just printing like a barcode central, that's what you want to avoid. Do not trade that. So you don't want to trade this, you don't want to trade this. This one you can kind of trade it. This you want to avoid. This you want to avoid. But once you see a price going up, that's when you want to like get in. If you have some sort of like an hourly crazy move up, that's when you want to go to 15 minutes and kind of start looking for the entry. So on the 15-minute level, as you can see on the hourly, we just have a straight shoot up. But on the 15-minute, we have more areas for us to either sweep internal, go up, or just come back to a certain POI and then go up. That's pretty much the only time I use 15-minute, is if when the hourly is just straight up shooting up without giving you any sort of opportunity. If I can see a big old candle is forming, That's when I switch to 15-minute. That's when I can see more opportunities for me. And that's if you have a clear target to hit. If, for example, if you don't have a clear target to hit, then I look at for some sort of psychological number, like for example 5,000, 5,050, 5,100. Round big numbers or psychological numbers that institutionals or algorithm likes to get in or get out of their big positions. That's how I think of getting in and getting out. That's my higher time frame bias. Hopefully that was helpful. So the next step would be getting into what accounts you should buy. So I'm gonna be unbiased and I don't have a code with most of these prop firms. I only have a code with a couple of these. But the one that I go to and I don't even have a affiliate code with it would be Lucid Trading. So as a beginner or somebody who never got a payout, I would go on a Lucid Trading and I wouldn't buy a Pro or a Black account. I would go to a Lucid Flex. It's probably like the cheapest one that you can get with a least amount of problem, highest amount of drawdown, and the easiest target to hit. And I've traded all kind of different accounts. I have traded different PropFirms account, different evaluation. I have traded direct to funded account. If you've never got a payout, never passed the account, Lucid Flex I would say is probably the best one for anybody who has experience or even for the beginners. So you just go to Lucid Flex, click on a 50K account. Don't buy a 25 account because the drawdown is a little bit too small. And don't get 100 and 150K. It's just a little bit harder to pass. So once you're here, once you get that 50K account, you can click on funded rules and you can see the clear rules. It's very easy. So if you're on a 50K, you can just click on select platform. Once you select on platform, don't click on the Redmake data feed. You want to click on the one that you can trade on either TradeAway or TradingView. So you want to click on CQG, DataFit, NinjaTrader, TradeAway, or TradingView. That's the one that you want to choose. So not only on this PropFirm account, but on any PropFirm account, that's the one that you want to choose. And once you get in, I will show you a login. So once you're on the TradeAway, you get your credentials emailed to you. You just click on login. Once you log in, you can click on Access Simulation on these prop accounts. Once you click on Access Simulation, this is one of my accounts. I'm going to show you for sake of simplicity. You just log in here. As you can see, it looks a little bit more complicated, a little bit less organized on the TradeAway. A lot of people trade on TradeAway. You can trade on TradeAway, but it's a little bit difficult to set everything up, and it just TradingView, as you can see, it's way cleaner to trade on TradingView than it is on TradeAway. So one of the most important thing is that as soon as you logged in, what you want to do is, here we go, if I can show it to you. Yeah, so I can show you. There's a settings section in here. Just click on your application setting. Go to your add-ons. Once you're at the add-on section, make sure your TradingView is active. So go to your add-on, go to your TradingView. The TradingView is active, you're good. You don't need any of the other ones, but you want to activate the TradingView. So once you're in the TradingView, you can just open this area. So let me show you that. There we go. So yeah, once you click on TradingView, click on TradeAway, log in with your credentials or whatever. This is one of the accounts that I have, and that's how you do it. So you can kind of see your account. So now you can click buy or sell, or you can click on set a limit order. You can just click on order rejected. You click on set limit orders, and then that's how you do it. Of course, the order is not going to go through because it's Sunday afternoon, the markets are closed, but you get the idea. That's how you do it. So let me just log out so I don't accidentally log back in. Let me click on paper trading. So you can go on a paper trading account and practice with paper trading if you never traded futures. That's how you can kind of practice your way into getting in and out of the market, kind of see what's going on. So we just finished foundation and setup part of this video. And we also covered ICC concepts, which is market structure, liquidity concepts, candle continuation theory. We covered all of that. Let's break down the candle continuation theory one more time. So if you don't know, so candle continuation is pretty much like if you have multiple candle closing beyond the other candle, as long as the body closes beyond the other candle, you kind of draw your line and get in whenever the candle closes below and then comes back up. And it's important for you to know it's not a wick. Like if it's a wick, it doesn't count. Your entry has to come from a place that when the candle closes below that line, whether if it's your POI or liquidity sweep, if the candle closes below those areas and grab all those orders and then start reversing, that's when it counts. Because if you get a wick, there's a very high chance of the price action is to give you a fake out or a dead cat bounce and then come back again. So in these examples, the price gave you two opportunities: close below it, grab all these order and start closing above it again. Let's say, for example, you see the price right here. So you see the price right here. You see your 15-minute that we come grab all these orders. You see the hourly that we came close below this one. We are start going back the other way. You just get in here. You put your stop loss below this area, which is around 80 ticks. And you put your take profit at 80 ticks. You either put your take profit at a 1-to-1 ratio. So I'm risking 80 and I'm getting out at 80. So with trading prop firms, it's very crucial that you always aim for a base hit or some sort of market structure base. So you want to get out and get in with a 1-to-1. If you're risking 80, you want to get out at 80. Risking 50, get out 50, 100 and 100. Or you can take out or stay in it depending on where the market is going. For example, in this case, you can have your full take profit at this area, which is your external liquidity, and you can have your base hit. You can do it two different ways. So you can take out all your contract in this area, which is because you're risking about 80, or you can take out two of your contract. For example, you can go here, click on sell, change the number to 2, and then that's it. So that way you've taken out two of your contract in here, and then if the third one hits, good. If not, you can just move rest of it to the break even. There it is. So two of them got hit. Once it got hit, then you can move your either to a break even area or put it at the most recent swing, which is this area. And then once we create another recent swing, then you can move it to a break even or again below the most recent swing. And then once we create another recent swing, then you want to move it that area just to be safe. There it is. So with gold or NQ or any of these assets, if we get that close to our target and we don't hit it, what I usually do personally, I close the trade manually. I either close the trade manually or I move my stop loss right below that most recent candle close. Because a lot of times price can get very close to that area and sellers or buyers can push the price down or up depending on if you're going long or if you're going short. It's kind of live example of how I think about it. Not live, but in a backtest, but I pretended that it was live. So it's really important to know if you are trading a correction, a continuation, or an indication on the higher time frame. You can trade any of them, especially if you're trading prop firms and your goal is to build up and hit your base hit and get out of the market. So for example, if you see a massive candle closure that we inverse a hourly or a 4-hour gap, so what you can do is pretty much draw your line like this. Get rid of that one so you can see it more clearly. Draw a line like that. Let's say you go to your replay mode. Let me just click that. There we go. So we have that. So we have that, and but we've been going up. So we've been going up. So you can trade both ways. So we had our indication in this area. So now we have two targets. We have this target and this target. Doesn't matter. If you wanted to short, you can kind of look for it to short. If you wanted to go for long, you can kind of look for it to go long in one of these areas. Get rid of that. So you have this area for a POI. That one is also POI. But if you wanted to know which one is short, which one is long, you can put that one short. Make this one a long. Make it blue for make it blue for long. Same goes with this one. Make it a POI, but make it a blue. There we go. And you also have this area, which you can call it a liquidity sweep. And same goes with this area. You can call that one also a liquidity sweep. So this is how you can think of it and how you can target. So this is a good example of where you should be thinking of what where the target is going to be. If we are going down, we have a POI and liquidity sweep for going down. And if you're going up, we have target for areas. For example, in here, you can also make that one a target. But since we close below it, there's no point on paying attention to it. Once this hourly closes, so we have this POI, and this liquidity sweep area for the price to start going back up again. So you go to your 1 minute, and you're gonna see if we're gonna close above any of these areas. So close below it again. And we start going and closing above it again. Once we close below it, close above it. Since we close above it in here, we close it above all these, and we are not making any more new lows. It's called a lower low. So this area is lower low, lower low, lower low, but we're kind of stuck in here. We are not making lower lows again. So this is a quick example of hitting a one-to-one. You just get here, and this is the area that you can take out because this is like your most recent swing. Your stop loss goes below this area, so then you target that area, and then if you get taken out, depending on if you're gonna close completely below this area, then that's when you wait for hitting this area, or you wait for it to start closing above it again, and then you get in again. If the first trade doesn't work, usually you have a second try at it. And if we go, and I have another rule, so if we close above these areas halfway through it or more than halfway through, I usually move my stop loss to a certain area that I don't want the price to go to, if it's a swing low or a swing high. There you go. So we had our stop loss below this area, and we had our take profit above that area. So even though our take profit was about 209 ticks, and our stop loss was 161 ticks, so the tick amount was completely out of what's the traditional one-to-one should be. Because most people say, oh, you have to risk this amount to get this amount, which I don't agree on. So you always want to trade based on the market structure. And as long as within your parameter of 1-to-1 or 1-to-2 on a prop trading account, you're fine. And you saw that we had to sit through a crazy ups and downs on that trade, but we eventually hit our target. So let's see if we can find a short example of this one. See if we can find a short on any of these levels. So we went above it, close below it again. And as you can see, this was the area that we closed below, close above it again. We are just trying to break above that. We failed to make a new high, and then we close below this red line. So that's when I get in again, put my stop loss somewhere around here, because that's the most recent swing. So that's 147, and we have two different targets. So we have this area for 82. We also have this area for 287. So you always want to take out your target at a certain swing. So let's say I want to take out, let's see. I want to take out 2 of my contract in that area. So we got stopped out again. Not again, that was the first time. So we got to stop out. So as you can see on the 15-minute, we had something we call a internal sweep again. So we sweep this whole area. When you see a multiple area that the price doesn't want to break through, if the price closes above it, then we continue that shift. But if we come grab this liquidity and start going back down again, that's when that's my second opportunity to get in. So if we close below this area again, then I'll get in. There it is. So we close below it again. This is our, did we close below that area again? Yeah. Wait for one more candle. There we go. Close below it again. And stop loss goes to that area. Take profit goes to that area. So that's slightly above the 1-to-1 ratio, and it also covers the loss from the previous one. Let's see if we're gonna hit it. Yep, we hit it just like that. That's why this 15-minute and the hourly chart comes handy. Kind of shows you where the price is going without you switching to 15-minute and the hourly. So yeah, I went over an example of it for a long, for a short, and simultaneously both of them. So I showed you what to look for. I showed you all the settings on your chart. I showed you how to identify a higher time frame direction, and also I showed you the execution and the way I think behind all these trades before I place them. And I showed you the idea behind your stop loss and break evens and take profits. So one of the things that most people don't understand is, what do you do when you're in drawdown? Let's say you have a $2,000 drawdown with a $50,000 account, you only have 2,000 worth of a drawdown. So this is how you want to think about it. You don't really have a $50,000 account. You have enough capital for worth about $2,000. And the way you want to think about it, how many tries it'll take me until I blow this account? If it's a $2,000 account, how many tries you want to give yourself before you're blowing that account? If you want to give yourself 4 tries, you can just do this, $2,000 divided by 4. So that way you can risk about $500 on each trade. Are you able to pass the challenge with only giving yourself 4 opportunities? You gotta ask yourself. 4 opportunities to be wrong completely. Or let's say you want to give yourself 10 opportunities on a $2,000 drawdown. It's very simple. $2,000 divided by 10. So that way you know how to risk and how much to risk. Because most people complicate the risk. They're like, oh, what if I do this? What if I do that? What's the percentage? Blah, blah, blah. Just divide it by the amount of number that you want to have before you blow the account. Simple as that. Let's say you take a couple of trades. Let's say you take a couple of trades and the drawdown go to about, now you only have 1,000 for the drawdown. If you have 1,000 for drawdown, same thing applies. You have $1,000 in drawdown divided by 10. Then now you have to risk $100 per trade before you lose the account. After 10 trades to be wrong, you have to trade extremely horribly for you to lose 10 trades back to back. But it does happen. The chances of it is very low unless you do something wrong. If you do a coin flip, you do a better result than if you lose 10 trades in a row. So under psychology and discipline, one of the things that you want to pay attention to is patience. So it's easier to look at the market and then decide what to do on a backtesting session versus on a live market. On the live market, you're going to see a lot of ups and downs and you kind of have to make a decision quickly. But if you draw your lines, if you zoom out and you draw your lines, you only see them like once, maybe twice, the opportunities. And instead of you just sitting on the trading view and try to get into every trade, and instead of just drawing your line and being patient, see if you get it, see if it feels right, looks right, and then get in. So the biggest thing with having a strategy is, does it complement or supplement your strategy? In other words, trade what you see, not what you think. So as a beginner, we all do good is because the reason why we do good, because we see the price is going down, we sell, we see the price going up, we buy. But then we add a strategy and we just go fully based on that strategy. You're like, well, if the price does this, then I get in. If the price does that, then I get out. You completely ignore what's happening on the chart. You can see the price is going up, but you want to short the market. Or you can see the price is going down, but you want to long the market. That's why I said it's better to pay attention to what is actually happening on the higher time frame. Simple as that. Just trade what you see, not what you think. That's why I have like this thing in here where it says trade what you see, not what you think. I have my base hit and stick to your plan. Just a quick reminder that if whatever that you want to be reminded about when you're trading live. So when you're reading it all the time, it's just kind of hypnotizing yourself to stick to the plan, base hits, trade what you see, not what you think. So you're not lost in the looking at your strategy and trying to hit that every single time. You kind of want to see what's going on and see if it fits that strategy. Simple as that. And the way you avoid overtrading or FOMOing is having those rules. So if you lose more than twice on one session, you're done. You lock the account or you lock TradingView and you walk away. Do not break that rule, no matter how good you get. 2 losses, you're done. 2 break evens, you're done. You shouldn't have a lot of break evens, but if you are, you're done. 1 good win or 2 small wins, you're done. Keep it that simple. Those are the rules that should be stuck in your head. And you want to journal. So journaling is very simple. Let's say for example, this was the area for us, or earlier, whatever we're doing. So we close below this area. This was our short area. So this is how you journal. Let's say you got in this one. You had your stop loss here. You had your take profit here. And the price didn't hit. The price didn't work out. And you had this area to this area. And the price closed below it. And then you got into this one. For example, this one didn't work, this one worked. So this is how you want to trade, how you want to journal it. You just write down, let's say, write down balance. So you want to write down your balance. Balance was, let's say, 50K, lost first trade, let's say 200K, won second trade, 400, 200 for the day. Potential was, let's say, potential was 1,000. Let's say you were emotionally trading it in a different way. Let's say before trading felt anxious, during felt fear, after felt relieved. And you can kind of write down that, and then you kind of like, you want to get ammo. I mean, ammo. You want to get an arrow. And for example, do this, do something like this, boom, boom. And then you want to get another arrow here, like do it like this, and then write down this was liquidity sweep, blah, blah, blah. And then you just write down, and then I go like this. This trade worked because blah, blah, blah. So you get the idea, like you start like journaling everything. You journal your entry, why you got into the trade, did it work, did it lose, what was your initial balance, end of the balance, how did you feel during the trade? Was it, were you sleepy, or were you anxious, were you hesitating? Write that down. During the trade, how did you feel? Did you feel confident? Did you feel anxious? Write it down. After the trade, how you felt. And then you can even go one step forward and add a certain emoji to those areas. And then once you're done, you can just go here. If it shows in here, let me see. There we go. Once you're done, go here, click take a snapshot and download the image. Once you download that image, add all of it into a Google slide or a Notion template, doesn't matter. And then at the end of each week, you will review it. That's the most effective way to journal. That way you can check all your journal once a week or at the end of the day. That way you start building a pattern recognition, so you don't make the same mistake over and over again, which is very easy for you to do. So yeah, the way you handle drawdowns, I went over it again with you. So the way you handle your drawdowns, you just divide your drawdown by 5 to 10 trades, and then you risk that much. It's pretty simple. And you just have to trust the process when you're trading live. That's the only thing that I can think of when it comes to how to trust your trades. You trust your trades by accepting your risk. If you risk $100, $50, $200, doesn't matter. However much you're risking, that's the first thing you need to think about when you're getting into trade. Think of like, hey, this is the amount that I'm willing to lose and I'm okay with losing if my trading idea doesn't work. So at the beginning, if you're not familiar with this model, you kind of want to backtest it. If you're completely new, you just want to open a paper trading account on TradingView and start paper trading for at least a month or two. And then once you're ready, you just get in it and you just take the same trade over and over again. Assets like gold and silver, I always recommend, since they're always going up, you always want to look for longs. And assets like Nasdaq and S&P 500, they kind of go through phases of being shorts and phases of being long. You kind of want to try it both on those. And you kind of want to stay away from everything else like crude oil, Dow Jones, or every other futures. So you want to stick with one or maybe two assets. My recommendation would be stick to gold and Nasdaq. Those are the ones that have the highest volume and the highest probability for you to give the most amount of trading volume. And at the beginning, if you never got a payout or you never passed a challenge, your goal shouldn't be to make money. Your goal shouldn't be to win the trade. You're winning the trade or you're winning your day if you stick to your process. That should be counted as a win. A win is not in terms of winning the trade. A win is not in terms of making money. A win in trading is when you followed your process 100% regardless of win or lose. If you follow that process 100% regardless of the outcome, that's when you start winning. Not when you make a certain amount of money or you made a certain amount of money. So at the beginning, that's how I used to think. I used to think if I'm making money, I'm winning. And then I switched my thinking process to, oh, if I win the trade, I'm winning. Then I had to switch that process again So nowadays, if I follow my plans and if I don't break my trading rules, that's the day I'm winning. Because sometimes you can do everything right and still lose with trading, and it's just part of it, and you have to be okay with it. It's far more difficult to accept losing trades than it is when you're not winning. So you want to change your definition of winning. So winning should be only and only if you follow the process, if you follow the rules. Because you can overtrade, you can revenge trade and win the day in terms of monetary value. But what you did, you actually lost because you built bad habits, and you're going to most likely going to repeat that because you have that in the back of your head. You have that in your memory that, hey, that day I did that and it worked and it may work again. And you do that and it will not. And you just get stuck into the same cycle of making money, losing money, making money, losing money. And that is why. I'm gonna go over my daily and weekly routines. My daily routines, I clear my mind. I meditate in the morning and afternoon. And that's how I clean my mind from any trades that I took from the day before. Or if I have any anxiety, I let go of everything. That's my daily routine. And my weekly routine, and part of it is also a daily routine, is checking economic calendar. You just go to a Forex factory, you go to your filter, and you filter all the red news event. You just click on red folder, click apply, change the time frame to either New York or your local time frame, and you see what's gonna happen the next week. So that way you can avoid a certain time for trading because it's gonna be super volatile on those hours. Yeah, if you're not good at trading news, completely avoid trading news. Either trade before or an hour or two after when the price action becomes clear again. And if you ever feel confused, or if you ever feel conflicted, or feel like you don't really know if the price is gonna go up or down, it's better not to take any trade. You just want to mark your trades and see if it's gonna do what you thought it was gonna do, and then build conviction based upon that. It's better to do that than to take a trade and hope for the best. You have to have some level of conviction, even though it's an extremely uncertain thing to do so, because the market is always uncertain. You can never solve the market. You can never find 100% certainty in an uncertain environment. But what you can do, you can have higher probability. If you feel like a trade is a higher probability, go for it. If you feel like it's a lower probability and your confidence is low, you just don't take it. You just don't take it. You just mark your levels and see if the price does what you thought it will do. And based on that, you build conviction and confidence. And one of the last things that I wish somebody would have tell me is protect your confidence. It'll take time. It can take weeks for you to build your confidence when it comes to trading. But all it can take is it can take one day for you to lose all the progress, for you to lose all the confidence that it took you weeks to build on by one day of not following your rules and over trading and blowing accounts. So next time you're about to do so, remember that. And it's better to have a lockout features either on your website or on your phone, so you can lock out everything after two loss, so you cannot even physically trade until the next day. And if you want, you can join the community. It's called Trading Made Simple by Ali. The link is in the description. Join the community, share your trades, and share your wins and losses, and we're going to help you out. So to wrap up everything, you just saw the full breakdown of my trading process, my psychology, and my risk management. If you think it was too simple, it really is. But what I'm about to share you, it's going to make it more effective. This is the same strategy that took me from blowing accounts and losing a lot of money to making 10K plus consistently every single month. You don't need years of experience, thousands of dollars in capitals, and thousands of hours of YouTube contents or garbage course content to get good at this. All it takes is a laptop or a phone and a couple hours a day for you to succeed at this. As you get good at it, it takes less and less time. Now I want to show you how you can apply to work with me directly one-on-one for the next 180 days. Here's what's included in there. We are going to fix everything that's holding you back. your entry, your exit, your strategy, your psychology. I'm going to build a trading system for you based on your individual capability, based on where you are in your trading journey. I'm going to create mechanical rules, chart setups for you, how to journal properly. I'm going to review your journals and help you with not guessing on every trade. You're going to have a one-on-one calls and real-time support. You're going to have my WhatsApp phone number so you can text me at any time you need, and we are going to hop on a one-on-one call once a week or as needed. I'm going to have a scalability plan and accountability plan. I'm going to hold you accountable every single day. You're going to have to send me all your trades and I'm going to review them with you. And here's my guarantee. If after 180 days you don't get funded accounts, I'm going to work with you for free until you do so. This isn't a shortcut. This is for people who are willing to put in the work, learn, and need somebody who holds them accountable. If you're ready to stop guessing and start trading with confidence, the link is down below. Go ahead and apply now. We're only going to take a couple of students and I'm going to see if I have any spot available for you. Yeah, just apply. Somebody will reach out to you. See you in the next one.